Hey everyone, welcome back to Corporate Decoder, the place where we explore the inner workings of big business. Maybe a little too closely, and folks, let me tell you, Kelly Services. Inc. just dropped a report that has got more twists and turns than a corporate labyrinth, and we're here to decode it all for you. Get ready to unpack a year of big shifts at Kelly Services. From surprising financial drops to strategic power plays that could shape the future of work itself. Before we dive in, if you are new here, hit that subscribe button and ring the notification bell so you never miss our deep dives into the world of corporate finance. And hey, our Discord community is buzzing with discussions about these kinds of reports, so join the conversation linked in the description below. Alright, first off, let's acknowledge this is a big yearly report, a 10K, which means it is the whole enchilada covering a full fiscal year that ended in late 2025. Now, Kelly Services Incorporated is a major player in the staffing world, connecting companies with the talent they need. But this filing screams change and a bit of a rough ride in 2025. Let's look at the money coming in. Overall revenue from services dropped by about 2% compared to the year before. That might not sound huge, but when you are talking billions, it is a significant chunk, and it tells a story that the demand for staffing services wasn't quite as strong as the year before. And when revenue dips and costs stay high, your gross profit takes a hit, and that is exactly what happened here. Gross profit fell by over 3%. This means that what is left after paying for the direct costs of providing services shrunk. That is like baking fewer cookies, but paying the same for flour and sugar, you are left with less profit per cookie. Now here is where things get really interesting. They recorded a goodwill impairment charge of $102 million. That is a substantial write-down. Imagine you bought a company for way more than it was actually worth, and now you have to admit it. That is what this charge signals, and it is bigger than the previous year. Adding to the pressure, these impairment charges are often a red flag that past acquisitions might not be performing as expected. And when you combine those revenue drops, higher costs, and those big impairment charges, it is no surprise that Kelly Services ended up with an operating loss of almost $70 million for the year. That is a tough pill to swallow, and it is much worse than the operating loss they had the year before. This next number is a real head scratcher. Income tax expense jumped from a benefit of $21 million to an expense of $175 million. That is a massive swing, and the report says it is largely due to setting up valuation allowances against tax credits and other deferred tax assets. Basically, they are saying that due to recent losses, it is unlikely they will be able to use some of the tax benefits they might have expected in the future. This is a significant financial hit. Putting it all together, the bottom line is a net loss of a staggering $254 million. That is a huge difference from just a tiny loss the year before. This really shows the financial pressure the company was under in 2025. Now let's break this down by business segment. Their enterprise talent management division saw revenue drop by nearly 9%. This is likely due to lower demand from some of their big clients, and also the ending of a major contact center contract. This segment is their biggest revenue generator. So a dip here really impacts the whole company. On the flip side, their science, engineering, and technology segment actually saw revenue growth of over 6%. This is partly thanks to an acquisition they made last year, Motion Recruitment Partners. That acquisition seems to be helping this specialized area stay strong, even when the broader market is a bit shaky. The education segment also showed a modest revenue increase of almost 4%. This suggests that demand for educational staffing and talent solutions remained relatively stable. Perhaps even growing a bit. This shows resilience in a segment that might be less tied to the broader economic ups and downs. Looking at profitability within these segments, the Enterprise Talent Management division saw its gross profit rate drop by about 0.7%. This means they're making less profit on each dollar of revenue in this segment. Factors like higher employee costs and a shift in the types of services they are providing are playing a role here. The science, engineering, and technology segment's gross profit rate also dipped slightly by 0.3%. While the acquisition helped boost overall revenue, the profitability on that revenue has slimmed a bit. You can see a theme here. Profitability pressure seems to be widespread. Now let's talk about the costs of running the business. Their selling, general, and administrative expenses, or SGA, actually went up by about 1%. This is despite the revenue drop, and it is largely because of those acquisitions they made, which added to their operational costs. And here is a big reason for that SGA increase: integration and realignment charges more than doubled, jumping 72%. This means they're spending a lot more money on combining acquired companies, streamlining operations, and restructuring departments. This is often a sign of significant internal changes happening to try and prepare for future growth, but it hits the bottom line hard in the short term. Let's shift gears to how they're managing their money. Their cash position position at the end of 2025 was about $33 million, down from $39 million. The year before this shows they're using cash to keep operations running and make those strategic moves. On the positive side, they generated $122 million in cash from their normal day-to-day business operations. That is a big improvement from the previous year, which is good news for their liquidity. They're also spending money on investments in their business capital expenditures, specifically dropped compared to previous years. This could mean they are being more cautious about investing in new equipment or technology, or perhaps they've completed major upgrades in prior years. Financing activities show a big outflow of cash, nearly $161 million used, compared to actually getting a lot of cash the year before. This is mainly because they paid back a lot of debt that they had taken on in 2024, likely to fund those acquisitions. This shows a move towards deleveraging. Now let's talk about the risks Kelly Services is up front. About their challenges, they constantly remind us that their business is tied to the economy. If businesses aren't hiring, then Kelly's business suffers. It is a pretty straightforward connection. They also highlight the fierce competition in the staffing world. It is an industry where it is not too difficult for new players to pop up. This means they're always fighting for clients, and sometimes that means cutting prices, which can hurt profits. And of course, there is the elephant in the room: technology, automation, and artificial intelligence. Kelly acknowledges that these advancements could actually reduce the need for human workers in certain jobs. That is a big risk for a staffing company that thrives on placing people. They also worry about damage to their brand, especially in areas like education, where they place employees in schools. A single incident involving an employee could really hurt their reputation and lead to lost business. It is a reminder that reputation is everything. Now, for the part that shows they're on top of their game, they have a report on internal controls over financial reporting, and they state that their controls are effective. This is important because it means they have systems in place to prevent errors and fraud in their financial reporting. The independent auditors from PricewaterhouseCoopers LLP agree with this assessment, which is a good sign of financial discipline. Okay, let's look at this huge list of exhibits. A lot of these are amendments to agreements related to their financing. These are important for understanding how they manage their debt and how they get cash, but they are pretty technical. They also have a lot of agreements related to recent acquisitions like MRP and Children's Therapy Center, and amendments to their credit facilities reflecting changes after those deals. They also updated their code of business conduct and ethics. This covers how their employees and leaders should act, and it is a sign they are paying attention to ethical practices, which is always a good thing. Alright, so what is the story here? Kelly Services is clearly in a period of significant transformation. They've made some big acquisitions and dives at some operations, which is a strategic move to focus on higher growth areas, but 2025 was a tough financial year with substantial losses and significant restructuring costs. The company is paying down debt, which is a good sign of strengthening their financial foundation, but they are also facing major market risks from economic downturns and technological disruption. Their strategic shift towards specialized talent solutions and AC Accessions like Motion Recruitment Partners seems to be boosting some areas like science, engineering, and technology, but the overall results show they're still navigating tough market conditions. The big question is whether these restructuring efforts and acquisitions will pay off in the long run and help them overcome those operational and financial headwinds. Overall, Kelly Services in a bit of a rebuilding phase. They've made bold moves, but the financial results for 2025 indicate there is still a long road ahead to achieve consistent profitability and growth. What do you think about Kelly Services' strategy and their latest financial results? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate decoding. We'll be diving into more filings like this to bring you the unfiltered truth about big business, and don't forget to join our Discord community. For more in-depth discussion, you can find the link in the description. Thanks for watching, and we'll see you in the next one.